All right, let's take a look at some examples of horizontal and vertical analysis. And this is a tool that can be used to compare a company's financial statements from one year to the next. So horizontal analysis, the example we're going to look at presents the balance sheet, but this can be done on any of the financial reports. Ultimately, what horizontal analysis does is it compares one year's to another year's results. For example, here we have some financial information for Artie Incorporated. We have been provided information about some of their balance sheet items, or actually all of their balance sheet items for 2 years. These are the balances in their current assets, plant assets, liabilities, so on and so forth as of December 31st of 2024. And these are the amounts they are reporting at the end of the next year, December 31st, 2025. So applying horizontal analysis to this company's balance sheet for 2 years, we are going to take this information and put it into our proper balance sheet form. So here, obviously, this is very simplified. We have grouped all current assets into one lump sum amount, as well as the plant assets. And then down here in the liabilities section, we've lumped all the current liabilities into one amount, long-term liabilities into one amount. Stockholders' equity, we have reported their common stock and their retained earnings. Adding together the assets, they should equal the liabilities plus the equity added together. So all of this information is just brought straight from the problem over here. Now that we have the balance sheet set up, applying horizontal analysis is very, very simple. We are going to first figure out the dollar amount of difference between the 2 years. 25,000 is the difference between 2024's current assets and the end of 2025 current assets. There was an increase, right? We're going to always use the very first year presented as our base year. So the base year amount is 100,000 and it increased to 125. So that dollar difference is going to be shown as an increase. Okay, we're doing that line by line, looking at the dollar difference between the 2 years. And all of these are increases except for retained earnings. 2024's ending retained earnings went down by the end of 2025. So we can see down here that there is a bracket which indicates a decrease. Okay, so the first step is to come up with the dollar amount of changes horizontally from one year to the next. And then to calculate the percentage change, we simply take the dollar amount and divide by the base year amount. Dollar amount of change divided by base year of 100,000. The change from 2024 to 2025 is 25% increase. Plant assets. The change from 2024 to 2025 was 66,000. 66,000 divided by the base year amount of 330,000. There was a 20% increase from 2024 to 2025. Total assets, $91,000 difference. It was an increase. The percentage is the amount of the change divided by the base year. 21.2% increase. Okay, what we're doing is we're going to do line by line by line. And again, this was the only line item that had a decrease. Okay, so what we've done now is we have created or performed the horizontal analysis, which, remember, when we are analyzing, that is only the first step in the analysis process. Once we have analyzed, then we need to go in and interpret. At this point, it's kind of hard to really truly interpret in the educational setting because I don't have management or I don't have people involved in the operations to be able to give me explanations about these changes. At this point, the only thing I can really do is look at, okay, was there anything in here that draws my attention? It's called management by exception, right? What is drawing my attention? Where as a manager should I focus on asking questions? Are there things in here that concern me that maybe we need to evaluate if something's going wrong? Or are there things in here that are good and I want to say, hey, whatever we're doing, let's continue doing it because we have a good result here. In here, there's not a lot of really big things jumping out at me as what would direct my attention as a manager, other than to see that assets only went up 21.2% from last year to the end of this year, but the liabilities went up 36%, right? So to me, that might I want to start asking questions. Why did our liabilities go up significantly when compared to the increase in the assets, right? That's a little concerning. Maybe there's a really good valid explanation, nothing to worry about, or maybe there's something that we do need to start looking at as managers to try to prevent continued increase in liabilities. Okay. So again, this is just kind of directing our attention to where we need to look for answers or look for good performance. Another tool that can be used is the vertical analysis. Horizontal analysis that we just completed was looking at comparing last year to this year, kind of looking across time horizontally. What vertical analysis does is it kind of just stays within a year and looks at the composition of each item in that year as a percentage of sum total. Okay, just like with horizontal analysis, that example was applied to a balance sheet, but we could apply horizontal analysis to balance sheet, income statement, statement of cash flows, right? We can apply it to all of the reports. Same holds true with vertical analysis. Our example that we're going to work with is applying this tool to an income statement, but we can apply vertical analysis to a balance sheet, statement of cash flows, right? So on and so forth. Right, taking a look at operating data for ARTI for the years 2025 and 2024, the amount of revenues or sales, cost of goods sold, which is the cost of the inventory that was sold to earn those revenues, selling expenses, administrative expenses, income tax expense, and their net income. They've given us all the information we need for an income statement. Over here, we're just carrying forward all of this information, presenting it over here. So here is 2025's revenues minus cost of goods sold calculates our gross profit. Recall that gross profit is reporting the amount of profits made off of just selling the inventory, off of their core operations. But that is not the same thing as net income because gross profit is a measure after subtracting just one expense. To calculate net income, we then have to subtract our selling and administrative expenses to get our income before any income taxes are accounted for, and then we subtract out our income tax expense to calculate our final bottom line net income. Okay, so we're doing this for both 2024 and 2025. Now to apply vertical analysis. We are curious, we kind of want to know what is the percentage of each of these line items, cost of goods sold, gross profit, selling expenses, so on and so forth. What is the percentage of each line as a percentage of their total revenues, right? So what we're doing is we are identifying revenues as the base amount. To determine what percentage each line item is of revenues, we are going to divide that line item by the amount of revenues. Okay, for example, revenues of $750,000 divided by revenues of $750 means sales are 100% of sales, right? Okay, well that makes sense, right? Sales are sales. Cost of goods sold. This line item, 465, divided by sales. Cost of goods sold is 62% of the revenues earned, right? In other words, 465,000 is 62% of the revenues of 750. Gross profit of 285 divided by revenues of 750, 38%. In other words, gross profit is 38% of the company's revenues. Selling expenses of 120 divided by our revenues of 750, Selling expenses are 16% of our total revenues. Right? We are vertically staying within 1 year, right? Vertical analysis just goes vertically up and down the year's income statement or the year's balance sheet or the year's statement of cash flows and coming up with each line's percentage of total revenues. Doing the same thing on the 2024 income statement. Each line item divided by the base amount of 600,000, 390 divided by 600. Cost of goods sold is 65% of total revenues in 2024. Gross profit of 210 divided by sales of 600. Gross profit is 35% of total revenues in 2024. Okay, so you probably have the idea of how to calculate the percentages. What does this do for us? Okay, well, we can now look at this and figure out, overall, are there any positive trends, negative trends? Okay, and generally this company had a very similar year in 2025 to 2024. Obviously, everybody focuses on the net income, and there was a slight decrease, less than 1% decrease in our profits. So now we can say, okay, that's not too bad, but let's see if there's something up here that we need to start looking at as potentially an area to keep our eye on. Okay. And looking through here, it looks like we did a good job of controlling the cost of the inventory that we sold because our gross profit 38% increased over last year. We have a bigger profit off of selling our inventory, so that's good. So what caused our overall income to go down? Well, it looks like our selling expenses were 16% of our revenues this year, whereas last year they were only 12% of our revenues. Okay, well, obviously we would prefer to have our expenses controlled and staying either the same or even coming down a little bit. So this might be an area for us to start asking questions, right? Go to the selling department and figure out, why are we spending more in the selling department to sell our inventory than we did in the past? Okay? Is it necessarily a problem? Not necessarily, but it could be indicative of, maybe you guys aren't doing a good job in the selling department of controlling your costs. So let's be more cognizant of it. Okay. But again, just like with the horizontal analysis, vertical analysis helps us manage by exception. We look at where we need to focus our concerns or our efforts, and that is where we direct our attention. All right, hopefully this helps with the application of these two tools.